Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Hi everyone. So where we finished yesterday was that we looked at the first two of our methods of applying modern portfolio theory to the actual data. Remember, the first method, this is where we finished yesterday, was to actually use mean variance optimization in practice. And that's what I'm going to take you through as part of the workshop today towards the end. We're going to go through using Solver to trace out the first of our efficient frontiers, and you guys will do other efficient frontiers in the Excel video as well. Now remember, what we said is that the key problem with mean variance analysis and portfolio optimization is how sensitive the optimizer is to small tweaks in your input assumptions. And remember, I said that ultimately the best way to think of Solver is it's like that puppy dog that wants to do right by you. It wants to do everything it can to please you, but it doesn't have the overlay of common sense that we do when we look at the output and see that it's sensible. So I thought that I'd start today by giving you something to sort of imagine in your head when you think of how hard Solver tries to please you and doesn't always succeed. This, can we zoom in? Let's see. This is my dog, Bobby. He's awesome. He would do everything he could in the world to please not just me, but anyone. But he regularly would break stuff, run into stuff, dirty stuff, whatever it may be. So you don't want this guy to do your optimization for you, okay? You need your overlay of common sense. So the computer's going to try so hard to get you a good outcome. But the chances are that outcome is going to look like this. It's going to give you an outcome like these weights here, which you just can't do in reality. You can't short your asset classes at all, let alone to this extent, unless you can trade in some kind of derivative. So remember, it's all about calming that optimizer down. So given that it does have that hypersensitivity to the input assumptions, the other way that you can use Solver, or at least, sorry, I shouldn't say use Solver, use modern portfolio theory, is to use it as the basis for a portfolio analysis workhorse. In other words, remember, we said that they had, we gained 3 enduring messages from modern portfolio theory. And they're messages so simple that you learnt them in Foundations of Finance, but they really do matter. They should be considered when it comes to constructing portfolios. If you keep those messages in mind, then you can use modern portfolio theory to help you gain a portfolio without relying on an optimizer that is so sensitive to small mistakes in inputs. Now, there's no doubt that this second method does take longer. The advantage of it, though, is that with every change to your portfolio, you're using your own reasoning with modern portfolio theory at the back of your head so that every tweak has a justification behind it. It's not the computer trying to get you the outcome that's best based on the numbers. It's you coming to the right outcome based on your own reasoning as to whether your portfolio is diversified, whether it has any latent unobservable risks that the data can't pick up. So if you're going to do that, and by the way, we're going to go through these steps in Excel video 4, which is what you guys will get in week 5. The first thing you do is you nominate a baseline portfolio. So that could be your legacy portfolio when you first come into a new fund. It could be your peer group average, right? If you guys choose to do this kind of method in the assignment, you might choose to start with the weights that the investor has, or you might choose to start with the weights of the peer group, because I'll give you that as well. Once Once you have your baseline portfolio, then that means you have a portfolio from which you're going to start to make small adjustments. The next thing you need to do is you need to decide how you're going to represent the distribution of asset returns. So you might choose to use a database method, you might choose to use a model-based method. You did both of these in Excel video 1. Right, remember you had all of your simple returns here, and you learned how to calculate the mean, the standard deviation, you used data methods to get your probability of loss, you used parametric methods to get your probability of loss, and so on. So ultimately, and we're going to talk a bit more about it next week as well, that comes down to making a call. Do I think that a normal distribution, say, is a better representation of asset returns, or do I think the actual historical data is a better representation of returns? Once you've done that, you're going to estimate your portfolio outcomes. So what's my expected return, my standard deviation, my Sharpe ratio, my probability of shortfall, my probability of loss, my tracking error, whatever measures it are that are important to your investor. Now, again, if you're going to do this using a non-parametric technique, there are two different ways you can do it. The first one is just to examine hypothetical historical performance. Now, we're going to go through this a couple of times in the next few weeks. But what we mean by hypothetical historical performance is we say, okay, well, hypothetically, if the past repeated again in the exact same way, what would our portfolio outcomes be? So you're not running a bootstrap, you are just drawing straight from the historical data to get to your summary statistics. The alternative method is to bootstrap, which, remember, you did in part B of the video, and just in case anyone hasn't done that yet, I will take you through the basic steps of the bootstrap later on today. But now you're going to run a bootstrap and you're going to get your different outcomes from that bootstrap. If you use a model-based method, you're going to be doing the same thing. You can either directly estimate portfolio statistics for a single period, or if you want to care about multiple periods, you can simulate by drawing from a model. So the single period version is when you use things like your Z-score and your parametric 90% lower bound using the normal distribution function here. Or if you want to have multiple periods, and I don't expect you guys to know how to do it, I'm including it for completeness because some people may wish to do it in the assignment, but essentially you can draw from a normal distribution for 5 periods, which you then run into your summary statistics. And that's actually included in your Excel video as well. Now, the reason I don't focus on the simulation for the normal distribution as much as I focus on the simulation for the bootstrap is simply that I believe that a bootstrap on a non-parametric method is a better representation of asset returns than a simulation from a normal distribution. Right? The majority of asset classes are not normally distributed. So personally, I believe that if you're going to do a simulation, it is better to focus on the data itself. If you disagree and you'd like to use a normal distribution simulation in the assignment, that's fine. But as I'll say in the assignment workshops, it would then be important to argue why it is you think that a normal distribution is a better representation from which to draw your simulation. And we'll talk about that from week 7 of workshops onwards. You then want to investigate the impact of changes. So in other words, you want to alter the asset allocation, perhaps add a new asset class that you haven't thought of. You might want to tweak your input assumptions for expected return, for example, and that you're going to do in Excel video number 4. You're going to tweak your expected return. But really simply, what you're trying to do is just say, all right, every time I make a tweak, am I getting better or worse? So if I add in a new asset class, are my portfolio measures looking better for my investor? Is my probability of loss lower? Is my tracking error smaller, if that's what I'd like? Is my return higher? So for example, here, if I change the weights to 40% Australian, oops, that's the peer group, ignore that, so let's go back. If I change it to 10% Australian equities and 60% world equities, I then say, all right, well, what happens to my measures? Am I getting a better return, a lower risk, a better probability of loss? For each change, you try to see whether the outcomes are improvements on the ones before. If they're not, you go back to where you started. But if you are improving the portfolio, then you're going to stick to that new change and try to make another change to improve it further again. And the reason that I quite like this method is that, in reality, every change you make, you're doing it for a reason. For example, you might say, well, looking at the investor's portfolio, I think that they're underexposed to Australian equities relative to the rest of the world, say. So in that case, because of that, I'm going to change it to 10% and reduce the weight in world equities. When you have all asset classes, like you will in the assignment, that's where things are going to start to make more sense. For example, you might say, look, there's quite a high direct property weight. I think direct property risk is artificially understated because of smoothing, because of appraisal valuations. I therefore think that the data makes direct property look better than it actually is. So as a result, I'm going to reduce the weight in direct property. However, one of the reasons I was invested in direct property is that it provides an inflation hedge against Australian inflation. To maintain that inflation hedge, I will invest in inflation-linked bonds or in commodities. And some of my commodities are Australian-based. Although commodities really, you're mainly hedging US inflation because they're usually quoted in USD. Right, but you see what I mean? You've got reasons for every tweak that you make, as opposed to this little computer trying to do everything it can to optimize the numbers, but it doesn't have that underlayer of common sense dictating it. Remember, if you are going to use optimization, if you are going to use Solver, the next step is to wait till Solver gives you your output and then overlay the common sense. Right? So if you were going to do Solver and you got to, let's find a bit more of a reasonable solution. A portfolio like this one highlighted in red, that's when you start to say, for example, well, for this investor, is perhaps the equity weight a bit low because they have a long time to retirement and they have a relatively high level of risk aversion. Relatively low level of risk aversion, so they can afford to take on a bit more equity risk and ride out the cycle. Or you might say, okay, I can see I've got 5% in listed property, 10% in direct property. Well, we know that direct property has issues with understating risk because of return smoothing, and you can see that the equity weight is quite low. Now, one of the things you're going to learn in your property week is that listed property has a higher correlation with equity than direct property does. So if you had a high equity weight, you might not want to take on too much listed property because of diversification. But if you're going to keep a lower equity weight, then you might want to actually take on some more listed property and reduce the direct property weight, because then you're still gaining the same exposure to the property market, but in a more liquid form, and you don't have too much equity risk dominating your portfolio. So you're going to learn as we go through the weeks more and more about the asset classes, and therefore more and more arguments that you might make to make sensible portfolios. I'm giving you examples now, but as we drill down into each asset class, you're going to get a lot better at looking at an asset allocation and saying, okay, there are the red flags, here's what I might change and why. And it's always about the why. And remember, when you're doing this, you have to be aware of parameter uncertainty. There's a reason that we call it expected return, right? It's not certain. You're making assumptions, you don't know the future. So you've always got to sit there and have at the back of your head, have I made an assumption that is going to drive the output? Have I overestimated return per unit of risk on an asset class? And if I have, what impact has that actually had? So one of the things that I'm still refining it, but I'll probably ask in the assignment, because I do tend to do this, is I tend to say, do two methods for an investor. So in other words, use two ways of coming up with an asset allocation. Have a look at whether they're different. Look at why they might be different before deciding on a final version, right? Avoid relying on a single model to get to your answer. So if you are going to apply mean variance analysis, so if you're going to use Solver, which I'll go through in a moment, there's a number of things you need to consider. The first is that you need to set assumptions. There's a range of different assumptions that you need to think about. It's a big deal, and that's going to be the focus of next week. Small changes in your input assumptions can have big impact on your results. You need to think about the distribution. So is mean and variance enough, or are there other measures that matter? For example, returns have historically shown what we call fat tails. Does anyone know what that means? Excess kurtosis, exactly. And what would that mean in terms of extreme events? They have a higher probability of occurring. Right, so if returns tend to have fat tails, extreme events happen more often than they would under a normal distribution. If that's the case, mean and variance don't suffice. Am I dealing with hedge funds? Because as we're going to learn, hedge funds actually have option-like payoffs. And we're going to talk about a range of reasons why that is in week 8. But if I'm dealing with or 9, I can't remember. But if I'm dealing with hedge funds, then again, I've got skewness, so mean and variance won't suffice. Think about your objectives. How am I going to characterize my risk-return trade-off? Is standard deviation enough, or is my investor more focused on the downside? In which case, I might want to look at something like a probability of loss, a probability of underperformance. Do they have relative or absolute return benchmarks? If they have relative benchmarks, tracking error is important. If it's absolute return, you might look at the probability of not meeting your target, say inflation plus 5%. So what else matters other than mean and variance? Maybe utility matters to the investor and they want to characterize their different outcomes using their utility function. You've got to think about the investment horizon. Am I a single period or a multi-period investor? So if I'm an investor that cares about a 3-year horizon, and I don't care what happens in the meantime, right? So essentially, I'll set an allocation now, do nothing, and I care about 3 years from now. Then my allocation would be different to if I was a 3-year investor, but I really cared about my performance in all of the 12 quarters over those 3 years, right? Perhaps I'm a fund manager that has quarterly evaluation. Am I a short-term trader? Am I a 10-year end investor in a superannuation fund? Your answers to this kind of thing with the investment horizon will shape how you set up your analysis. For example, in the bootstrap here, this one, bootstrap, we have 5 draws on annual data, which we compound out to the value after 5 years. That's pointless if you're not a 5-year investor, right? If you were a 3-year investor, how many columns would you have under the bootstrap? 3. If you were a 7-year investor, you'd have 7, right? You need to decide what your horizon is to figure out how you're going to shape your tests. You need to think about how many assets you want to invest in and which ones. Are they all available to me? Maybe hedge funds aren't available. Maybe you're too small an investor to get a decent private equity fund to even think about you in terms of taking your money on. And then you want to ask, is there anything missing that I haven't accounted for? So, for example, is liquidity really important? And maybe if that's the case, I should add in a constraint that limits the amount of illiquid assets I can invest in. Do I care about intra-period cash flows or not? So if I'm a private equity investor, I'm going to raise all of my capital at the start, I then close the fund, and I spend the next 10 to 12 years entering and exiting my investments before the fund is actually closed. But if I'm an open-ended mutual fund, I could get inflows at any time, and I could get outflows at any time as well. So that means I need to be very careful to ensure that if I get outflows, I have assets that I can liquidate at a decent sum, at a decent point in my strategy of investment to actually satisfy the outflows, right? Even if I'm investing in really liquid stocks, if I'm purchasing because I think they're undervalued and the value will correct over the next 3 years, then I don't want to have to sell that stock 1 year from now when I think it's still going to be undervalued in order to satisfy a redemption. If I'm a private equity investor, though, or a general partner, then I know that I have that money locked in, which gives me a lot more freedom. Okay, so that's the end of the conceptual part of it. Now I want to take you through some Excel work. But a couple of last things to remember. I've said this so many times through the lecture, but it is so important, and it will be so important in your assignment as well. Mean variance optimization is so easy. We're going to see it in a moment. You set up Solver and you hit run. So it is really tempting to rely on it. You can use it as part of your asset allocation method, but you have to have common sense overriding it. You have to be doing the thinking for the machine because it will not do it for you. Right? It's a framework for analysis. It doesn't make your final decision. The other thing I wanted to say is about the readings, and that's because I've had a couple of people sort of look at me very wild-eyed and said, some of these readings are really big. Please note, when I list a reading, sometimes it's only a couple of pages, right? So this week's reading from Vanguard, it's only pages 6 and 7 that's examinable. Sometimes I give you a 100-page document, but I actually only want you to read 5 of them. So please keep your eye out when you have a reading, whether I've said only pages 5 to 7 or whatever it may be. I will never ask you to have an examinable reading where I actually expect you to go through a 100-page document. So just keep an eye out. I don't want you guys going home going, oh my God, that woman's awful. She makes me read like 5 100-page things a week. So I do list the page numbers alongside it. Now, any questions before we go into the workshop side? All right, so the workshop is really just a bit of a recap for some of you that might be rusty on a few different concepts, and then I'm going to show you a little bit of Excel work as well. The videos, you really should be looking at the videos each week. They give you all of the detail to go through the analysis, but sometimes it's nice to do it together so that if you guys have any questions, you can ask as we go. The first thing I wanted to do is a quick recap of simple versus log returns, their formulas, a numerical example, an Excel example, and how that translates into arithmetic and geometric mean. In this course, you're going to be using simple returns a lot. You're going to be using log returns a lot. There will be times when geometric average is appropriate. There will be times when arithmetic average is appropriate. And what matters is that you need to use the right formula for the right measure and the right measure for the right purpose. Right? There'll be times where if you use an arithmetic mean, you will be incorrect. And I'll show you why that is today. But what we have here is we've got time, so today through to time t, we've got wealth, and we've got simple and log return. I'm sure you guys have done this so many times. Remember, simple return is wealth at the end of the period divided by wealth at the beginning of the period, and then you subtract 1. Log return is the log of end wealth divided by starting wealth. Now, you might have to calculate log return from wealth. You might have to calculate it from simple return. And you might need to calculate simple return from log return. And you'll see that a lot in Excel. We often convert one to another. If you have simple returns and you want log returns, the log return is the log of 1 plus the simple return, the natural log. Now I've put, in case anyone is interested, the arithmetic that will get you there. If you have log returns and you need to calculate simple returns, the simple return is the exponent of the log, and then you subtract 1. And again, I've put the arithmetic at the bottom. Okay, so they're the basic formulas that you're just going to use again and again as you calculate your returns and you convert them and you compound them up to ending values. The next thing you're going to use a lot is arithmetic and geometric mean. So for example, you might think that expected return for a single period is the arithmetic mean of all the simple returns for the last 20 years. And that's something that you did in Excel video 1. The arithmetic mean can only be gained from using simple returns. Do not calculate the arithmetic mean from log returns. You will be incorrect. If you want the arithmetic mean, you take all of the simple returns, add them together, and divide by the number of observations, right? It's just your equal weighted average. This gives you the average return over the periods. The geometric mean doesn't give you the average return, it gives you the average rate of wealth accumulation. So the second you start to care about performance over multiple periods, you should look at geometric mean if you care about how wealth accumulates through time. Now, geometric mean you can calculate using simple or log returns or wealth. It's just really important to use the right measure for the right purpose. Often in the assignment, I will see, for example, this formula applied to log returns, which of course is incorrect. And it's a really simple thing that you don't want to lose marks on by getting it wrong. If you have simple returns, then all you need to do is add 1 to each of the simple returns and then multiply them together. You raise the answer to the power of 1 over t, and you subtract 1, t being the number of periods or observations. If you have log returns, then the first thing you do is you calculate the arithmetic average of the log returns. You then get your actual geometric mean by the exponent of that average and by subtracting 1. I'll go through examples in a tick. And if you have end wealth, then you should use it because it's really, really easy. You take the ending wealth over the beginning wealth to the power of 1 over t and subtract 1. So if you're given a bunch of wealth values, don't bother going through the return series if you don't have to. You can calculate your geometric mean straight from the wealth itself. Here's a numerical example that just puts the numbers into the letters that you saw in the previous, right? So you've got different numerical levels of wealth. From there you can calculate simple returns, log returns, convert between the two, and calculate arithmetic mean and geometric mean. And you can see that irrespective of the formula, you get the same answer for geometric mean as long as you've done it correctly. Now, the reason I wanted to show you this is that, remember, if you want to look at wealth accumulation, you have to look at geometric mean, not arithmetic mean. Because if you compound the arithmetic mean, right, you've got 3 periods here. You have an arithmetic average return of 14.3%. If you compound that up over 3 periods, you will have an end wealth of 1.493, which is too high. Compounding arithmetic mean will always overstate the end wealth. And the higher the variance, by the way, the worse that's going to be. And we'll look at that next week. The geometric mean is 10%. And if you compound that for 3 periods, you get the correct value for end wealth. Now I'm going to take you through, I wrote out a really easy, obvious example. But before I take you through that, let me ask you guys a question. You start the period with $1 million. You invest for 5 years. And at the end of 5 years, you end up with $1 million. So you started with $1 million, you ended with $1 million. Have you gained any money? No? Easy, right? But arithmetic average doesn't tell you that. Only geometric does. And the reason is that geometric mean reflects that you need to make money back before you can earn a positive return. All right, so you've probably seen this kind of example in past courses. Right? Let's say that you've got 2 periods. You start with $1 million, you get a simple return of 25% in the first year, negative 20% in the second year. So over the first year, your 1 million grows to 1.25 million. In the second year, your 1.25 million falls to back to $1 million. So you can see end wealth and beginning wealth are the same. You haven't accumulated any wealth over the period. If you calculate the arithmetic mean, though, you'll end up with 2.5%. That's the average return across the 2 periods, but it's not the average wealth accumulation. To get the average wealth accumulation, you need the geometric mean, and that will correctly reflect that it's 0%. The reason this is so important is think about your assignment, right? Let's say that your investor requires a minimum return per year from their asset allocation of 12%, right? If you incorrectly calculate the arithmetic mean, 12% per annum, and it grows over 3 years. Let's say they're a 3-year investor. If you take the arithmetic mean and you grow that over 3 years, then you're going to think that you have satisfied that investor's constraint, but you haven't, potentially, because remember, compounding the arithmetic mean will overstate end wealth, right? So you don't want to do that. You want to compound the geometric mean. You don't want a situation where you think you satisfied the investor's constraints, but you haven't because you've used the wrong formula. Now, I've also put these in an Excel illustration that you can play around with. This is on Wattle. You can see you've got wealth figures. Thank you. Oh, sorry, let me know if I ever do that. Thanks for that. You've got wealth figures. You've got simple returns. You're going to use the sum product function on simple returns to get your investor portfolio returns. You've got your log returns. And I just wanted to raise attention to this bit here. When you have simple returns, to get your portfolio return, you can use the sum product. It's just the weights, the weighted average of the different asset class returns, and the weights are the wealth invested in each asset class, your asset allocation. But if you want the log return of the investor portfolio, don't use the sum product function on log returns. It is not designed to be used on log returns. The sum product function should only be used on simple returns. So what you do instead is you get your portfolio simple return using the sum product function, and then to get your log return on the portfolio, you say that it is the log of the simple return of that portfolio. That's just, it's an important distinction to remember. You don't use sum product on log returns. And when I take you through examples in the assignment, you'll see that come through again, because we're going to adjust the log returns, then we're going to take it back to simple returns to get the portfolio, and then we're going to log the portfolio return to get the log of, well, the portfolio return, right? But we don't use the sum product on the log returns themselves. We then, from these, can calculate arithmetic mean using simple returns, geometric mean using either simple returns, log returns, or wealth. And as you can see, irrespective of the measure you use, you get the same outcome. These amounts are equal. So you can play around with that too. And I do recommend, you've got the formulas, play around by hand, play around in Excel. Play around by hand because I might ask you to do it in an exam. Play around in Excel because you might need to do it in the assignment. And yes, I might ask you to do this type of thing in an exam. There's very little math in this course, by the way, so your exams will probably have a weight of somewhere between 10 and 20% calculation. Really low for finance. So whenever you see something you can calculate by hand, you should know how to do it, and that includes the Excel videos. If it's a simple calculation that you can do by hand, know how to do it, because I might ask it to you. It's a small feature, calculations by hand, but I've got to include something like that in the exams. Any questions on that? Yeah. Yes. Why we derive log returns? So log, well, you don't have to necessarily derive log returns. There are ways around it. But the reason that we use log return, and actually I wonder whether I have an example here. Let me see, hang on. I don't. All right, let me go to the bootstrap. I'm actually glad you said that. So see how here we have a bunch of log returns, and we're going to compound that up, whoops, to end value by using the exponent of the arithmetic average, like we saw in the formula. If you used simple returns, what you'd need to do is you'd need to say that that amount is equal to, bracket, 1 plus the first simple return, close bracket, times 1 plus the second simple return, close bracket, times 1 plus the third simple return, close bracket. It's a much more complicated formula. Now, it's fine when there's only 5 periods, but if you need to compound up 24 periods, you don't want to be using in Excel bracket 1 plus the return, close bracket, times 24 times, right? So we tend, when we're using Excel to get end value, we tend to use logs, because then you can just say exponent. You can use this one here, exponent, bracket, sum of those returns. And then to get the annual one, you can take it to the power of 1 over 5 and subtract 1. Right, so it's just a much easier calculation. Now, if you're adjusting your expected returns based on an end view of multiple periods, and we don't do that yet. But if you have, there are other scenarios where you have to adjust log returns, but we haven't got to them yet. At the moment, we still have flexibility of what to use. You just need to use the right formula. Any other questions? All right. Now, this one is so basic, and you've done your Excel videos, that I won't go through how to do these, but I've listed them for you to play around, just in case any of you do need to scrub up on your Excel. These are really common functions that we're going to use through the course. The next thing I wanted to take you through, and you may have already done this in the video, but it's how to run a bootstrap simulation. Now, a bootstrap simulation, essentially what we're doing is we're saying, all right, well, we have a bunch of historical data. This is a data-based simulation. Those historical data came with a bunch of returns. We think that the past is a good representation of the future, and we think that any of these years could occur with equal probability. So rather than just look at 31 observations, which is what we have here, we're going to draw randomly out 5 different possible series of observations as one simulation. We're going to repeat that 1,000 times, although in your assignment I will encourage you guys to use 10,000 because you get a better description of the distribution. But what we're going to do is we're going to have 1,000 independent draws of combinations of these 31 years, 5 years each time. So the first simulation might be December 85, followed by December 95, followed by 89, followed by 05, followed by 09, right? They're different combinations of the past, because you're saying that the past could occur in any order, and we're looking at 5 different combinations of it, so 5 different years in a row. I'm going to talk to you in the next few weeks about some problems with that, because it does assume that the returns are independent through time, which in things like direct property is violated. So in the assignment, we'll talk about which measurement intervals are better for a bootstrap and which aren't because of that assumption of independent returns. But for now, I just want you to understand the method. So the notes take you through everything that you need to do. Essentially, what you're going to do is you're going to go to your data analysis. You're going to run a random number generation. You're going to have 5 different variables and 1,000 random numbers. And by the way, this is all included in the screenshot. So you've got 5 variables, 1,000 random numbers. You're going to do a discrete distribution. If you wanted a normal distribution, you'd pick normal, but here we just want discrete. The value and probability input range. Well, we're going to randomly draw on the years, right? The first year we're going to call number 1. And their probability of occurrence. So 31 possible years, each with a 3.23% chance of occurring. And we're going to put the output starting from cell G5. And your computer will think not for too long, because it's only 1,000 simulations. This one's a bit slower than mine. But in a moment, hopefully, it's going to output. There you go, your bootstrap. When you do 10,000 in the assignment, this might take a bit of time, so go and get a cup of tea and relax. Come back about an hour later and it will have appeared. Now, when you do this, you've got to check that the outputs make sense. You've got 31 years, right? So you want to make sure, and here's a good example, the minimum here is 0. Sometimes your computer will do this. You just run it again to get a minimum of 1, because there is no year 0, right? There's only year 1. So you just repeat it, and occasionally it does it. It's really annoying. When it does, you just repeat it till it gives you a minimum of 1. It should have a maximum of 31. Again, if the maximum isn't 31, it's not a good representation of the data. So you want to run it again until you get that correct maximum. The average here is fine. The average is 16.032. The average of the values 1 through to 31 is 16. So as long as the average of your simulation is about 16, you should be happy with it. So check the minimum is the actual minimum, the maximum is the actual maximum, and the average is correct. So that's your bootstrap. thing I wanted to show you how to do is how to actually use Solver. And again, the Excel video will take you through all of it in detail, but it's sometimes nice to do it. Any questions on the Bootstrap, by the way? It's sometimes nice to do it in a way that if you do have an issue with any of the steps, you can stop and ask me. So if you're unsure about what I'm doing, just stop me and I'll explain it. So remember how we use Solver. We say, all right, computer, first of all, give me the minimum variance portfolio. And then remember we say, give me a portfolio with a slightly higher return that minimizes the variance. And then you say, well, give me the weights that has a higher return again that minimizes the variance. And you trace out the efficient frontier that way. You're going to impose constraints. I'm going to show you the first one, which is what we call unconstrained optimization. The only constraint we're going to include here is a budget constraint. In other words, all of the weights in the asset allocation need to sum to 1. That just means we're fully invested. I want to show you the baseline, and then that way when you do the Excel video, you're going to add in the additional constraints and see the impact that it has. Right, so that's just what I said here. You've got a fully invested portfolio. You might choose to add in other constraints. You will in your Excel video. And you're going to specify the level of expected return and ask Solver to minimize the risk. You could also do the reverse, by the way. You could specify a level of risk and ask Solver to maximize the return. And that would give you the exact same frontier. So, this is the Excel video 2. The summary at the moment is all blank. As you fill in the answers, this sheet will populate. You've got your total return values. You've got your unconstrained optimization tab. This is what we're going to fill out. And you can see that the first thing we have is a bunch of returns here. We're going to calculate our mean, our variance, and from that, we're going to run our optimization. So to get the mean, and by the way, every one of these steps is outlined here, including the functions to use. So we just want the average monthly return. We're going to approximately annualize that by multiplying it by 12. It is an approximation. You probably already know, and we will do in the course ways to do that more exactly, but this is just to illustrate the portfolio frontier. You want the monthly variance. And you want to annualize that. Now, this is really important. To annualize it, you want the square root of the variance times 12. All of that, the variance times 12, needs to be within the square root. If you know how to get the mean, we just times, to get the annual mean, we times the arithmetic mean, the monthly mean by 12. If you calculated the monthly standard deviation and you multiplied that by 12, you would get a crazy standard deviation, and your optimized would basically just give you 100% cash, right? And the reason is that you can linearly scale mean and variance, but not standard deviation. Standard deviation, if you wanted to do that, you'd need to say times the square root of 12 to get the right answer. Now, I've outlined all of that here, right? And this is all assuming returns are IID, which we've said, by the way, is typically not valid, but modern portfolio theory and mean variance optimization assumes IID returns. So essentially, you can't linearly scale the standard deviation by multiplying it by time. You need to multiply it by the square root of time. So I've included the reasoning as to why here. Please don't do the wrong thing in your assignment, because you're going to end up freaking out and, as I said, allocating 100% to cash, because the risk looks way higher than it really is. All right, so you've got your formulas, you drag them across, and you're ready to use Solver. So Solver is really simple to use. We're going to start with the minimum variance portfolio. We've got our portfolio return, our portfolio variance, and our weights. At the moment, these are equally weighted as a starting point. You've got to have something in there to begin with, and you've got to make sure it sums to 1. So and remember I'm including screenshots for you to follow in your own time, but you say, all right, solver, I want you to minimize my portfolio risk, right? This is the risk of the whole portfolio, not the asset classes. Minimize my portfolio risk by changing the weights in the different asset classes. Oops, that should be 6. Oh no, they should all be 7. Sorry, I did a weird drag there. By changing the weights in the different asset. Thank you, Solver, but I wasn't ready. So by changing the weights in the different asset classes, subject to the constraint that this is equal to 1. Now, it might good or it might forget. Yeah, it's done. Okay, cool. Now, just let me go back to have equal weights in all of them, so I can go back to what it used to be, right? So now you can see the budget constraint is 100%. In other words, wealth is invested in every asset class. So if you have a look, you say, all right, solver, I want you to minimize risk by changing the weights in these cells, and the only criteria I'm going to impose is that the weights need to sum to 100%. You then ask solver to do its work. It will come up with a solution, and that solution appears in the cells here. You've also got to manually enter the Sharpe ratio. Remember, the Sharpe ratio, and it's shown here, is the return on the portfolio less the risk-free rate. Now, you've noticed we've left cash out of the analysis here. That's because we've decided to use cash as our proxy for the risk-free asset. That won't always be a valid assumption depending on the investor, remember, but if you're a short-term investor, cash would be reasonable, and you're going to divide that by the standard deviation. Now, the other problem, that's your Sharpe ratio. The other problem with using the average return of the historical series of cash rates is it's giving you a cash rate of about 7%. At the moment, that's way too high to be a realistic assumption for the future. We're going to talk about that next week. But this is just assuming equally weighted averages. We will learn methods to override that in future weeks. Now, you're going to copy that, and you are going to value paste it into the cell below, and that's going to be your first point on your efficient frontier. What you then do is you start to go up the efficient frontier by using this little part here. We're going to add a certain amount onto our portfolio return to give us a return target. And then we've got here a different cell that takes the current portfolio return and subtracts the target. The reason we do that is then it makes it really easy to just keep using solver, tweaking only one value. And I'll show you how. So what we're going to say is, all right, well, we now want 0.05% return above the return of the minimum variance portfolio. So we then say to solver, do everything you were doing before, but I now have an additional constraint. And that is that this different cell is going to equal 0. Because when it equals 0, the portfolio return equals the return target. You tell it to solve. It's happy. You copy this through. Then you value paste it to get the second point on your frontier. Now, I'm not going to obviously do all of them, but I'll do one more to illustrate why we set it up that way. Let's say you want 10% above. All you need to do is change that to 10% above the minimum variance portfolio return. You now want to minimize the difference between the return target and the current portfolio return, which remember is 5% above. And you don't need to change solver at all because you still want to make this cell equal to 0, right? You just say, same thing, solve. And it will come up with a return, a portfolio that has a return that is, again, 0.05% higher. Copy that, paste it, and you get your next point. So you keep doing that until you get to the full minimum variance frontier. Now remember, we don't rely on it because in actual fact, these are not feasible solutions. So what you're going to do for the rest of the Excel video is impose additional constraints that are going to start to make your solutions look more feasible, so that by the time you get to your final version of the efficient frontier, you have more realistic weights. Not perfect, but more realistic. And I'll give you even more constraints to use in the assignment to get a reasonable allocation. So all of the steps are included here. The discussion is exactly what I spoke about in the lecture, right? Your output is only as good as the constraints that you impose. The only thing I wanted to note is, sorry, this discussion was done last time. World equities hedge is no longer short there, so I've just crossed it out. Okay, thanks guys. That's it for today. Any questions? Yeah. Guys, there's a question. What's the difference between the minimum variance portfolio and the risk-free asset? The answer is, if you look at modern portfolio theory, the risk-free asset has no risk, where the minimum variance portfolio is the combination of risky assets with the lowest possible risk. The minimum variance portfolio has risk, but if you're going to invest in risky assets, that's the lowest risk around. Does that make sense? The risk-free rate is literally risk-free. So this is the risk-free rate, whereas that's the minimum variance. Thanks guys, see you next week. How you going? They're the years, that's right. So this is the return in year 1, return in year 2, return in year 3, return in year 4, and return in year 5.
So, just like check for official 1 year, we have one method like
No, it's not days, it's possibilities, right? So the way to think about it is, damn, I don't have it. So these correspond to returns, right? So one possibility is these 5 returns. Another possibility is these 5 returns. Another possibility is 3. So think about each row as a different potential path ahead. We don't know what the returns will be over the next 5 years. Here's one option, here's the second option, here's the third option. And there's 1,000 different options of return sequences over the next 5 years. No worries. Oh yeah, cool. So there's another class here. You're welcome to talk until they come, or we can go up to consultation, which is fine too. I'll just pack up. Are you happy to come up with me to discuss it? Yeah. To discuss in console? Yeah, cool. All right. So sorry, guys. Are there other questions before?
Yes.
Yes.
So we go to your consultation now?
Oh yeah, you're welcome to come up to consultation, or you can ask me here until Joe comes. But it's up to you. Whatever's easiest.
Yeah, maybe I go to your consultation.
Okay, cool. Any quick ones, or do you want to? Yeah. The examinable reading, it's all about. Yeah. So it's all about knowing the key messages of each reading. So if there's a formula that we never discuss in class, you never apply, you don't need to know it. It's about getting the key messages. So for example, there's a reading that talks about the different ways to estimate alpha. Yeah. So the key messages are, here are the 4 different methods, and understanding them about them, but you don't need to know all the specific examples or numbers or dates or anything like that. It's just, if I basically said, what is this article about, you need to be able to talk about it.
The final exam, what was the steps, how much will be the weightage for the get question and for the
Yeah, about 10. But now, I haven't written the mid-sem yet, so I will tell you guys before we go in, but probably 10 to 20% most, right? It's going to be concept. So it's going to be multiple choice and then a couple of short answers. And there'll be some will be numerical in each case, but it's mostly going to be concepts and examples. No worries. No worries.
Yeah. Yeah. Oh, yeah, right. Okay.